All right, I'm going to do a quick intro for the YouTube recording, and then we will get into it. Oh, and I can't minimize my screen when I'm recording. That's great. All right. So, how would you like to invest in the top 500 companies of the world, plus generate an additional 10 to 12% passive income year over year from holding the S&P 500? Well, today we're going to be talking to Garrett Powala and some of his team from Neos. They design ETFs and that use special mechanisms built into their design that allows you to use option covered calls and puts to generate passive income on top of holding the overlying asset. Today, we're going to talk to him and learn a little bit about these ETFs and how they work, and then how you can use them to generate more income off of your stock market investments. Real quick though, if you're watching this on YouTube, make sure to join the Discord to be a part of these calls and our newsletter to be notified when they're happening. So we've got a lot of people on the call today, so I'm going to run through real quick on the intro, and then we'll hop into this. So first, we've got Garrett Powala, the co-founder and manager partner of Neos, Ben, the CEO of Composer, Donovan, the associate manager and producer of Composer, Jesse Greeter from Private Equity Group, Ram Samalucha, professor of university at Buffalo and computational biology, Ryan Hale, owner of Property Management Group in Muncie, Clay Ratterman, database analysis, Jim, USMC, he's a interested businessman and investor with broad experiences. And then we've got multiple people from the Discord, our lead admin, Vox, Derek, one of our lead architects, mods, Jason Kaz, and more architects, DJ and Brian, as well as Hassan, Raykion, Roperito, who are coders, and then Proteus, a scientist and data analyst. So with that intro done, let's hop into it. So Garrett, I'm sure that you have multiple napkin presentations on this stuff. I'm sure you've probably done this a few times over. You got like a 5-minute, 15-minute, 30-minute, hour. Let's do like a quick 5 to 10-minute explanation of like what this is, and then we'll get into questions and diving deeper into it.
Yeah, thanks, Aaron. So we here at Neos Investments are a global asset manager that focuses on issuing investment products primarily in exchange-traded funds to deliver innovative outcomes, mostly focusing on either risk mitigation or yield enhancement across a lot of your core underlying investments in your existing portfolio. Our team's been doing this for well over a decade. We've pioneered some of the largest option-based ETFs in the market at our previous companies. We've come back together in the last year to form Neos and really build what we think is an enhanced, version across equities, fixed income, cash, alternatives, and even digital assets, which is another product that will come out in the next few months with us. But as you think about what it is that we do and the application for somebody's portfolio, it's how do you invest in either your core equity exposure, such as like the S&P 500, but use a more conservative covered call type strategy, which tends to be the more simplistic that people do in options, meaning you're not taking leverage, you own the underlying investment that you're pairing with the option, and to generate a significant amount of current income for the portfolio. Or how do we look at enhancing the income off of, let's just say, core bonds or even cash, which is one of our newer products we have in the marketplace that we've been getting a lot of interest on. So, Neos has, the team has built obviously some of the largest option-based ETFs in the marketplace today, and we really wanted to take an innovative spin on creating that across your entire portfolio, so that depending on what risk tolerances or income needs one investor might have, they can basically choose more of their targeted exposure, being core bonds, equities, or cash type investments.
Okay, so one of my first questions that I was going to have with these is how are the option spreads calculated? Is it a weekly, a monthly thing? Is it all automated through code? Do you have like somebody personally managing that portfolio? How does that work?
Yeah, so we have a team of over 12 here at the firm that are across operations, portfolio management, trading, finance, compliance. Our team, though, at the core and everything that we do from an investment process is all quantitatively based. So we basically want to create what we feel takes the highest probability analysis of delivering our investment objectives. So what does that really mean is we take millions of data points from how equities perform, such as the S&P 500, what the options market is telling us from all of the various analytical methods of the Greeks. And what we want to do is create a rules-based systematic model, but driven off of quantitative, both short, medium, and long-term data to basically deliver the outcome that we're looking to achieve, which for our S&P 500 high income ETF, that is being long the full S&P 500 in full replication. So we own every one of the underlying equities because it's the most cost-effective and tax-efficient way for the investors to gain the exposure. And then on a monthly basis, to answer your question, we look to implement our data-driven covered call strategy. And what differs on this product than some of the other ones in the marketplace today is that we look to ladder our calls. So we're not selling just one call that could be 2% out of the money and letting it sit there for 30 days, right? We're selling something that's portion is 2%, 3%, 4%, and really trying to target a yield generation. And so what that looks like on average for us is around 1 to 1.5% a month that we want to generate from the options. And then the rest of the portfolio, we want to do two things with. Either allow the equities to not be capped, and so that you're not selling away all of your upside participation in order to generate an extra or excess amount of income, or we take a portion of the call premium to buy a long call so that we can participate with more of the upward swings. So when you think about the model, everything quantitatively based, when you think about covered calls and equities, right, you want to try to preserve as much of the upside appreciation for your total return of your portfolio. And historically, covered calls, the biggest negative is how much of the upside you give up in order to generate income. And so really what we're trying to do is accomplish the fact that we can generate you what we feel is a sufficient amount of income, 1 to 1.5% a month, but then allow the rest of the portfolio to be able to appreciate. And that happens on a month over month basis. So, we're not having to day trade so much and trying to constantly reset the portfolio for whipsaws, but we've basically taken a short, medium, and long-term analysis to find the most optimal time period, to basically be generating income off of selling cover calls.
Okay, so you're essentially reducing the noise by doing monthlies and getting out of the chop. And so do you switch? You said you switch the strategies. You do like a long call if you feel like the market's moving bullish instead.
Yeah, so there's two things. So we'll sell these monthly call options at varying degrees in order to protect the upside. But our model can indicate two things: either writing on, let's say, 75% of the portfolio and not 100% in order to have more upside, or in certain environments, the model will tell us to pick a portion of that income generated from the short call to buy a long call. Those times really happen more, I would say, in a very low vol type environment where volatility is really low, calls are really cheap to be bought. And so you might get better performance by being long the call. To date, the fund hasn't bought any long calls. It just hasn't written on the entire portfolio.
Okay, yeah, and I know enough about options to have a conversation, but not enough to be dangerous. So if anybody, I know we've got a few options traders in here, and I have Hassan in here specifically. He's actually a coder who designs coded strategies using options. So if you have any questions too, Hassan, feel free to chime in.
You did just ask one if you want me to answer it now, or we could jump to that.
Does anybody have any questions currently, or I can keep going?
Yeah, Hassan just has one. How do we compare to JEPI?
Yeah, sorry, I just had a question. It's like I'm very, very familiar with JEPI, the JP Morgan. I think they're doing some similar stuff. They're probably the most famous one. And I wanted to understand if you can compare and contrast a little bit.
Yeah, happy to do that. So we launched the second ever covered call ETF in the market. That was QYLD. It's the NASDAQ 100 covered call. It's still out there today. It's under Global X's brand and umbrella. But I tell you that as in, so we know basically all the other products out in the marketplace. We have a good sense of them. What JEPI does, and which launched about almost 3 years ago now, I think as of April, they do two things. One, they run an individual stock portfolio from JP Morgan's, equity research desk, which essentially gives you, I believe, a equity allocation that's a little bit more value tilted. That's obviously worked in the last 12 months or so. It's a mix between kind of the S&P and the Dow. So they're doing a single stock allocation, and then what they do on their covered calls are actually doing those via synthetic, meaning they're creating equity linked notes. So they go to a variety of different banks, JP Morgan, Goldman, Credit Suisse, et cetera, and they sell a synthetic SPX index option. That gives them whatever defined metric or percent out of the money that they want to generate. However, what that does is it's a fixed income instrument. And so at least what I know, and I'm certainly no tax expert, and so consult a tax expert, but that is an ordinary income. So your distribution of the 12% yield is, because it's a fixed income instrument, it's ordinary income that you pay as a tax rate, versus we use S&P 500 index options. So everything for us is an SPX option, because the IRS allows us to categorize any returns, income, capital gains that we earn off of the options at 60% long-term capital gains rates and 40% short-term. So tax advantage. So that's a big component of everything we do here, is it's about tax efficient income. And so from JEPI's standpoint, yes, single stock allocation versus we're long the S&P 500. And then two, they do equity linked notes, which are, synthetic, over the counter options that they're creating. And those tend to have a ordinary income tax rate, as opposed to what we do in an index option that gets a 60-40 treatment, regardless of the holding period.
So this gets, sorry, go ahead, Hassan. Did you have more?
Yeah, no, in regards to taxes, since it's an ETF from the retailer investor's perspective, it'll just be long-term capital gains after a year out, right?
So it depends from when you bought it to when you sold it of the position. Yes, the underlying distributions, though, those are taxed based on whatever the pass-through of the underlying investment is. So if it's traditional fixed income, right, that tends to be ordinary income that gets passed through. If it's these index options like we trade, then that's a 60-40 tax treatment. So it depends on what the underlying investment is. One of our products is long treasuries. And so treasuries, the distribution and the income earned off of that are exempt from state and local taxes. So that's a pass-through as well. So it's really about the underlying. But if you bought an ETF at 25 and sold it at 26, and had it for over a 12-month period, it'd be a long-term capital gains on that $1.
So it sounds like these strategies would be very attractive the higher portfolio value. If somebody's generating a couple $100,000 a year in income on top of their portfolio, this gets really attractive.
What we try to think about generally for any investor, regardless of tax bracket or even structure, is how do we deliver the best net after tax return, whether that be total return or income. And so thinking through the underlying investments and the instruments that can be used even within the very tax efficient ETF structure allows us to really think about how many dollars are fully taken home at the end of the day, and not just generated from a very, kind of more high flashy, hey, this yields 10, 12% or 15 or 18%. What do you end up getting after you got to pay the taxes? Yeah,
that sounds very attractive. But one thing, I hate paperwork. Do I have to file a K1?
Nope. These are ETFs. So you buy them and sell them in your own brokerage account or IRA account. And everything just flows right through into your 1099. And they're not like MLPs either, where you get a potential K1 distribution or anything. These are all just traditional ETFs with underlying equities, fixed income, and option exposure.
Okay, so I got a few questions in Discord. They're saying, ask if they track SKU and term structure and how they think about picking their points. I don't know what that means, but I'm assuming you do.
We do look at all of that. Our models, we tend not to get into this level of detail, because most investors that want to talk to us, are trying to keep more of a high level profile to it. But generally speaking, yes, we look at all Greeks, we look at all type of the volatility surface. And basically what we try to do is figure out where is the most optimal calls to be written, or puts to be written, depending on the portfolio and the fund that you'd be allocating to us on. And we're assessing not only just the the underlying stock price and where that index might be from a fixed income or equity, but really what is the options market telling us, and how do we consistently seek to deliver, right, our investment objective without having full discretion, right? For us, it's about models and systematic and knowing where it fits in a portfolio, as opposed to these strategies in an ETF format to where we're sitting there and actively managing it more like we would potentially a private fund or a hedge fund, where everybody understands that, there's going to be, full discretion, and that we can, take and change based on, a win.
So on a high view question, you've been designing these types of ETFs for 13 years, right?
That's correct.
So when it comes to bear markets, so I've shown you a little bit about Composer and how you can design logic gates for designing strategies. We often switch back and forth between different asset classes based on what the S&P 500 is doing, whether we're in a bear market or bull market, and then we can also compare returns from commodity prices versus equities using like parity switches. When it comes to bear markets with your products, you're generating roughly 1.5 to 2%, 1 to 1.5% additional income on top of the market crashing on the equity dropping. Does the income actually increase more as we turn into a bear market and downside, or do you usually try to keep it at 1% per month?
Yeah, it's a good question. So basically what we're trying to seek to do is generate 1 to 1.5% when we put the options on. That's really going to be regardless of where volatility and where the market is. So if the market sells off and volatility is higher, if we had sold the same call options, let's call it 2% out of the money prior to the crash and volatility being elevated, yeah, we might have generated, let's call it 1% to be 2% away from where the current market is. After that sell-off, in order to generate 1%, you might be able to be 3 or 4% away. So we actually stick more with focusing on just generating the 1 to 1.5%. And allowing the portfolio then to not be capped, because what tends to happen, obviously depending on the market, is you get a reversion to the mean and you get a bounce. And if you had then just wrote all of your calls at a low level, like some of the passive index-based covered call strategies out there, if you look back at COVID, they sold the same thing, an at the money call every single month, regardless of where the market volatility or the income was. And so, yeah, it helped a little bit on the downside, but as the market started to rally, you were fully capped, and it takes you a really, really long time for your overall underlying principal to be earned back. So what we think more about is, if we can still generate the 1 to 1.5% a month, then let's try to be farther out on the portfolio and be able to allow the equities to be able to rebound.
Do you have a target cap ratio you're trying to achieve then? No more than X% gets pulled out at any given month?
Yeah, from writing the calls against, like how much of the portfolio we write against.
Yeah. Well, how much the notion you write against, but also how much do you model is going to get triggered? How much risk are you taking on losing the alpha?
Yeah, so there's not a fixed percentage. It basically looks at what is it going to take for us to generate that 1 to 1.5%. That typically ends up looking, somewhere between like the 60 to 80%, overlay. So about 60 to 80% of the fund would have a covered call structure as an overlay, and the rest would be left, as upside appreciation.
All right, reading some questions real quick. If anybody else has questions in the Zoom, go ahead and ask.
Yeah, so I had another question was, SPX options are, you have history for them, right? The question I had was, have you guys done any sort of simulations, like going back 12 months or going back 24 months to see? I'm assuming this is a fairly new ETF or it's about to launch. I'm not sure if it's actually public yet, but have you guys done simulations to see what have the performance been through COVID or last couple of years or something like that?
Yep. So the fund did launch, all these products launched the end of August of last year. So they have about 5 months worth of performance. And we've gone through, and our research goes all the way back to, pre-2008. We look usually through 2007, 2006 to make sure we still have decent option data to ultimately do that research. I can't share what that is, from a compliance standpoint and talking about, any historical performance pre the fund launching. But yes, everything we do looks at, things all the way back through the, great financial crisis, and usually through at least 06, 07. And then we assess, like, how does that drive the model of a performance of maybe a 2008 environment? How does 2020 into COVID, where you're down 30, 40 and then back up? Then ultimately, how does it look even in 2022, where you have this kind of precipitous decline? So we try to take all market cycles and have a good understanding of what is it going to look like, performance through each one of those.
Sorry, I'm looking at charts right now to check out. So I see SPYI, since you launched, you've already returned back to even on where you launched from. But when exactly did you launch? How much more do you have till we recover, or how much better has your portfolio performed compared to the SPYI? And for everybody that's wondering, the asset is SPYI, SPYI, if you want to look at the chart.
Yeah, so when we launched, the S&P in September was down over 9%. I'm not sure exactly, 9.3 or so. We were down about 7%, a little bit more than that, I think 7.5. So we basically delivered the 1.5%, of the downside protection from the income generated. And then through basically the launch till last year, the end of last year, I know, it was relatively even. We actually captured, because we outperformed in some of the down draws, and then we underperformed slightly in some of the up months, we were pretty much relatively flat to earning the same that the S&P had. This month's a little different. I know we are underperforming the S&P on the month, just because it's been such a severe, rally to the upside. I don't know exactly what it is right now, so I wouldn't want to say a perfect number. But the S&P has us by now because of the upside capture for this month.
Do you do so when you do your entries and exits and stuff, is it purely on like the first of the month, or do you do like a 2-week stagger?
Yeah, so for SPYI, we do that on a monthly basis, since we do that at the end of the month, and we look about 6 weeks out. So we'll go to the full month's expiration. That'll be a full next expiration. So we basically initially have kind of 6 weeks worth of duration, and then when there's about 2 weeks left, we'll roll back out. So every month we're resetting the options. And what we found, at least in our research, in our opinion, is that kind of 6 weeks is that sweet spot of generating enough premium from the sale of the option, but also getting what we feel is the right amount of decay, so that you're earning the options premium in those types of flat to slightly bullish or bearish months. And so we feel on the call option side, 6 weeks is the right duration. On the other products where we're selling put spreads, then we get into those whenever you want later, but those are actually on a 2-week duration, and we roll every single week, because selling puts, we want to be even shorter duration. We want to reset on a weekly basis. And that gives us the fastest, in our opinion, decay to earn the premium. And we match those with fixed income. So those S&P 500 index options are either paired with core bonds or with a cash, like a treasury type allocation.
Okay, so Aaron Crockett's got a question. QYLED has some issues with equity value loss, but with very good income characteristics. Has SPYI taken any steps to mitigate that equity loss or equity value loss?
Yeah, so the equity value loss is going to be generally the same in the structure that we're long an underlying equity index. This one's S&P 500, QYLD is the NASDAQ 100. But what the structural issue, when you kind of look at the QYLD and those types of just at the money based products or their indexes, because those track all passive indexes that the CBOE has issued, is because you're selling an at the money every single month, it's hard to earn back the appreciation. So in a COVID type environment, you sold an at the money, you generated maybe 2.5% instead in that kind of February, March timeframe. Then the market sells off 30%, you sell it at the money, and the most appreciation you'd have back in the market would be whatever premium you generated. And so let's just call it even 3 or 4%, you'd be capped at that 4% until the next month. So what we've done to take and counteract and enhance what we felt is passive index-based option strategies is what I mentioned before. We ladder our calls, so we're out of the money. We're not selling something at the money. We go out of the money on those options, and then we usually diversify across a couple of different calls. So we might sell something, again, 2%, 3%, 4%. For us, we usually look at delta as our metric there, but some people on this call certainly know and understand that, others might. So we take a delta threshold, more of where we set our calls, but that gives us kind of a level of out of the moneyness. And so that for us, we'll look at a more wholesome total return, in our opinion, and upside, within the product that would help with the actual equity that Aaron is talking about.
Okay. All right, so I used to work in life insurance, and I studied index universal life policies quite a bit, but they use a point-to-point yearly system. And Jesse, he actually owns an insurance company. Did you sell the insurance company? Is that processed yet, Jesse?
It is in process right now.
In process. So you know more probably about this than I do, Jesse, but this sounds very similar to the same strategies that life insurance uses. Are you familiar with that process with options and hedging?
Well, not so much, because I'm in property and casualty insurance.
Okay.
So there's different, I mean, typically the investment holdings for property and casualty are just straight, like typically 80% bonds, 20% stocks, mutual funds, ETFs,
Okay.
stuff. But there's like no options trading and stuff. You have to be pretty risk averse because you need the liquidity in order to pay out losses.
Yeah.
So, by the NEIC, there's a lot of guidelines for what you have to follow. So, options are typically more risky than a lot of other investment vehicles. So
the way that I was told on index universal life policies is they take they buy bonds as well, but they take that like 2% return and then they roll that into options for an outsized return, because 7 out of 10 years we go bullish. But
yeah.
Okay. Well, speaking about bonds, then let's jump into that. So SPYI is the one product on equities, but you also have a BSV asset that does the same process, as well as basically a short-term 3-month bond, BIL. Is that correct?
Yeah, so we have 2 other products. We have BNDI, which is our core enhanced income core bond or aggregate bond ETF. What that one does is essentially it owns AGG and BND, the 2 largest kind of aggregate core bond ETFs out in the marketplace. Within the management fee, we rebate the 3 basis point expense structure to own those 2 ETFs. And really why we own the ETFs is that it gives us diversification and exposure to, roughly at least 15,000 bonds across those 2 ETFs. So most efficient way to trade, plus also the most tax efficient structure, is that so we can own those 2 ETFs and not constantly be turning over taxable gains to be potentially distributed out of the ETF. And then from an option standpoint, what we're doing is essentially selling out of the money put spreads on the S&P 500 index. And why do we use S&P? Is that historically equities and fixed income have inverse correlations to one another, or at least a significant amount of negative correlation. And so when you think about institutional investors and what pensions and endowments do, they're usually selling cash secured puts on their fixed income, and they're selling cover calls in their equities, and they manage their exposure internally, of what they're trying to meet to meet their basically, their liabilities. So we think about that institutional structure into an ETF that could be accessed by the masses. And so the idea behind our option strategy is to seek around 2 to 2.5% of additional income, but trying to pair and match the risk exposure and the volatility of the options to what you're getting in core bonds. And why do I say that? All is where would you put it in your portfolio, right? We want it to be put in a core bond allocation portfolio. So if your historical core bonds have roughly a 5% standard deviation, we want to keep that roughly within a band that would be achievable within a comfort level of an investor in core bonds, and which allows us to basically kind of generate 2 to 2.5% of additional income. So BNDI right now has ability to distribute north of 5%, based on its historic, versus where kind of core bonds are at like 2.75, 2.8 or so. So the idea is generate additional, kind of tax efficient income on your core bond allocations, and trying to keep with, relative vol and risk characteristic.
Okay, got a few questions on that. So you said, okay, so does BNDI have a lot of times we design with beta in mind, so we do a lot of rebalancing on portfolios, and we try to use either strategies or assets that are uncorrelated to get that outsized rebalancing. Does your product BNDI actually have a lower beta to the SPY than straight BSV or the 2 main ETFs that you allocate to?
Yeah, so it's going to have very similar. It's going to be slightly higher. I mean, very slightly higher. I don't have the number in front, but it's basically going to be almost comparable volatility, meaning standard deviation or beta, to what the underlying fixed income is. We add a very little amount historically to the volatility, but add the yield increase on top of it. So I'd have to pull it up on Bloomberg to give a specific data point, but it should roughly track with just a slight higher volatility than the underlying.
Okay. Now, Franklin Pierce has got a question. For QYLED, the seemingly best YLED, you're capped at getting about 1% payout per month, but have all the downsides at the QQQ. You're better off putting QQQ and just selling 1% per month and giving it to yourself. It wasn't a question. Okay, so wait.
Yeah, no. I can still answer that though. So he's also not wrong. So he's very much right on. So what QYLD does, again, I haven't managed it in many of years now, and they've, I'm sure, changed, some of it is that they're trying to distribute 1% a month. But what ends up happening when you're in an at the money covered call strategy is that you cap so much of the equity upside, you're not able to appreciate. So in order for that product to generate 1% a month, you kind of need the market to be flat to up about 1% every month. That obviously historically doesn't happen. So in those really good years where the Nasdaq was up 30, was up 40, that product is going to be up significantly less because it's capping all of its upside. So you would have been better off in that case because you've capped so much of the upside that you could have been long just the Qs and have sold out of it. So it depends on what you're looking for in it, but generally those at the money index based strategies are really capping a significant amount of the upside.
Okay, and so SPYI mitigates that by essentially capping at a higher threshold per month. So you allow that upside movement more before you hit the cap.
Yeah, exactly. We want to be out of the money on those options instead of at the money. We want to ladder them so there's varying degrees of out of the moneyness, and then we don't want to write against the entire portfolio. That way the equities can still appreciate. And when we don't write against those portfolios, right, we don't have to sell any equities to mirror any of the liability from the short call. So, right, if the options didn't make money and you had to close those out, right, you have to sell some of your equities to close it out. They are European options, so they're all cash settled. But by not capping your upside, you basically never have to touch part of the fund that is fully long just the equities.
Okay, so you're scaling out and you're also not fully in position on the covered calls.
Correct.
The next question I would have then, this is a very technical one. Do you input any kind of metric into your data analysis for inflation? And do you scale based on volatility and the VIX or any kind of metric on inflation and commodities?
So nothing goes into the model for inflation or commodities. We stick with the underlying S&P and what the S&P options market is also telling us. So by taking that delta metric for where we set our calls, that's able to move based on where the market is. So if the market is sold off, volatility is higher, whether that be because of inflation, geopolitical risks or concerns or issues, just simply draw down the equity markets, an unknown behavioral environment, right? By setting in a delta threshold, that's going to allow the calls to move. And so instead of maybe being at a 2% out of the money, that delta for, let's call it a 30 delta, might be a 5% based on where volatility is. And so that's what's helping us set it, as opposed to looking at maybe all sorts of macro and economic factors, that could be unknown or could change at a whim. We want to look at what the options market is pricing in, which in theory, the option market should be pricing in basically all of that, right? It's taking all of the fear in the market, it's taking all the hedging, and it's giving us all these Greeks that's implying where's skew, where's volatility, where's the gamma, where's all that, and those things are what are helping us drive, the call selection.
Okay. Anybody have any questions so far? Anybody else? And Franklin's got one more. Ending the question was NEOS as badly capped in the bull market as QYLED was? So they weren't running. They weren't active. The fund wasn't active through the bull run of inflation and COVID and stuff. But with that said, have you released any backtest or analysis on how your portfolio would have, or how your fund would have performed during the inflationary phase of COVID? Because that's what I was kind of interested in seeing is the analytics, and then comparing that returns to the out of sample that's been running live so far.
Yeah, unfortunately, we can't do any of the historical pre-fund, but trying to use the fund since the last 5 months, we've kind of seen, S&P down 9% in a month. We've seen the S&P up 6-7% in a month. And so generally looking at those months is where you'd see the upside capture. In our opinion, right, yes, the upside capture has been much better than where you would be if you were just capped at the money. But we'd all have to go back to looking at what the total return of the fund was during those kind of 5 months, as opposed to something that's historical, unfortunately.
Okay. So to play devil's advocate, what would ideally be when to use your product versus when to use just the straight SPY or just straight bonds? What's the downsides and risks and drawbacks if you were to itemize them?
Yeah, so for SPYI, you're going to use the product to generate more tax efficient income. So if you want to have a percentage of the upside and total return of the S&P 500 with slightly lower volatility, but generating more tax efficient income for your portfolio, you would allocate to SPYI. If you think it's going to be certainly a very bullish market, then no, right? You're going to give up some level of upside, in the fund to generate that income. And so if you don't want the income, or you just think that the broad market is going to be much, much healthier without any chop or volatility, then you just allocate to the straight, equity-based product with no options. It depends on where and your portfolio is for what product you want to use of ours. So based on the 3 that we have, you kind of have the S&P 500, which generates you much more high current income with S&P like volatility and exposure and risk. You would also move to the BNDI product if you were wanting to be in more core bonds and thinking that that was a better allocation, but want to get a little bit more income off of it. And then if you're much more conservative and you want to be in more of a cash-like product that would compare to BIL, then we have SCHI, which is essentially long the 90-day treasuries, and then sells again that laddered put spread strategy that we talked about in BNDI, but just even more conservative. It's basically further out of the money, and that seeks to generate 1 to 1.5% a year in additional income above what you're going to get in treasuries. So it just depends. You kind of want to be more cash, core bonds, or equities. We try to give everyone the ability to pick what fits best based on their risk profile.
Okay. So I want to get a little technical into spreads and bid-ask spreads, as well as volume and liquidity and stuff. But before that, as far as roadmap goes for future products that you might have lined out, so we design a lot of strategies with momentum switches. So we'll switch to a short position depending on what's happening in the market. Do you have any plans on your roadmap to release inverse, 1x inverse systems of what you currently have?
Short answer is no. It's really hard to go out and sell the inverse products. ProShares and Direction and everybody does a really good job at it. We might sub-advise for another issuer, some inverse related like single stock products, but for us, it's hard to just go out there and try to convince people why they want to just short all the time and be 100% short or leverage short. So for us, we wouldn't bring those out. We're focused more on the income component. If we issue something in the go forward, it'd be more of like a hedged equity type product, or how do you hedge? But that wouldn't be like a net short. It'd still be a net long position, but we'd be trying to reduce like the volatility in the drawdown. But those could be on the docket, in the future.
Okay, well, maybe we can change that in a few years if Composer gets extremely popular and everybody starts using algos to do inverse hedging.
Sounds good.
All right, I don't think we have any other questions. So let's get to volume and bid-ask spread. So we've talked a little bit about this, but I'm sure not everybody in here understands. Explain how volume works, because if you look at the chart on your products, they don't have a lot of liquidity, but they're actually attached to the overlying asset.
Yeah, that's correct. So all ETFs, ours or anybody else, the liquidity for the actual product of an investor buying or selling an ETF is always a function of the underlying investments. So how liquid are the underlying investments? For us, extremely liquid, right? We're in the S&P 500, options and equities. We're in core bonds, and we're in treasuries. So basically some of the largest and most deep liquid markets out there. And so what that allows is market makers to either create a tight spread or be able to allow the product if somebody wants to come in a large size buyer and price things relatively close to NAV, even though the products might not have a lot of trading volume. on the day, it doesn't mean that the underlying liquidity, isn't there. It's really a function of what the underlying investments in the ETFs are, ours or anybody else's for that matter.
Okay, so if you get a big block trader coming in, dropping a lot of money, you're not going to see a movement or anything like that, or have any kind of liquidity issues?
Correct. Yeah, all ETFs are managed with market makers. There's always a lead market maker, somebody that's designated that has to make a market. They basically, sign up to be either your lead market maker is called, or designated liquidity provider, DLP, depending on the exchange. And for them, all they're doing is creating new shares in the ETF or redeeming shares out of the ETF, as opposed to like a single equity that's got a fixed amount of shares outstanding from the company that's issued them, and everybody's got to buy and sell with one another that fixed amount. So that's when liquidity gets tough when you're buying and selling single stocks, is that there's a fixed amount of liquidity on the marketplace. For ETFs, every day they're either creating new shares or redeeming old shares. So you're able to get, a relatively, close to NAV price, depending obviously, of course, on the product and their underlying investments.
Yeah. Not to mention, I think I did the math in the Discord a couple of days ago. I think the SPYI liquidity, dollar amount liquidity is like $50 billion a day or something like that.
Yeah, that sounds probably about right. I mean, it's substantial, right? Being the largest benchmarked, index in the world for basically everybody, and the largest kind of traded volume. I think I saw something like it's traded, 11 trillion, notional or something like that. I think on an annual basis, which is incredible.
Okay. So we can't do this on Composer. Composer just does one trade a day, but theoretically, if somebody was to go in and day trade a bunch with one of your assets, how does the bid-ask spread? Is it impacted, or is it the help of the volume from the overlying asset? Does that assist with bid-ask, or do you sometimes have a wide bid-ask?
Yeah, the bid ask can be wide because they're slightly newer products. It's something that might have been out for years or have, tens of billions of dollars. So what I'd say is the majority of people in these products are buying and holding them. They're not trying to day trade them. They're more income oriented products. So they're used as kind of asset allocation building blocks. So what we find is that, somebody might sit there, always use a limit order, right? In any ETF, whether it's ours or even SPYI or something, when you can, we always suggest anyone to use a limit order, just so that you're getting filled, at a reasonable price. Sometimes you get ETFs where market makers are asleep at the wheel, and they're basically not looking, and whether that's the market on open, the market on close, or some other times you go and you sweep what's, potentially out there in liquidity, you get up, 15, 20 cents away from market, and that could go up $1, right? Because they just don't have enough liquidity provided there. So we'd always suggest to use a limit price, regardless of, whether us or anybody else.
Okay, yeah, I'm looking at your bid ask right now. It looks like you've got about a 10-cent spread, which is not bad.
It goes back and forth. It depends. A lot of times right now it could be 10 cents. Sometimes it gets down to 5. Sometimes you see it sitting at 2. It just depends, like the natural buyers that are also in there and what market makers are there that day. Literally what market makers could be there from a, is there a backup on the trading desk that day? That's going to look different. But generally speaking, 10 cents. On these types of products, 5 to 10 cents should be, kind of on average.
Okay. Got a few more questions. Do they use market orders or limits for options they sell that differ from the out of the market, in the market, or at the market?
Yep. So we always use limit orders when we're trading our own options. So within the fund, similarly, it depends on the size. Everything's really liquid. In our SPX index option, it's the most deepest and liquid option market out there. But we'll still always use a limit price to make sure that we get a fill that we want to get, and never just go to the market with it.
Okay. Left field question from Dom: does crypto impact your world in any way? It doesn't sound like it to me.
It doesn't in these products. If we want to try to find out how much correlation in the crypto market comes back, we think, generally, I think a lot of people would argue that, more NASDAQ related exposures, in the last 3 years or so, has somewhat of a correlation back to the equity markets from crypto. Maybe that's disentangled, post last year. We do look at the crypto market as we're getting ready to launch, a potential digital asset Bitcoin based covered call strategy, but that's not out in the marketplace yet. And it's going to be in a little bit different format. It can't be done in ETF, but it's got to be done in a little bit different of a structure. So short answer is no, it doesn't affect these products.
Okay. Do you somehow peg your option limit orders to move with the market, or just set it and forget it until it's filled? I'm assuming like a trailing maybe.
Yeah, so no, we definitely move our limit orders. Our traders here and investment professionals have well over 20, 25 years experience of trading and portfolio management. So they have the discretion on getting the options and the execution filled. So it depends on what's going on in the marketplace. Most of these products and a lot of ETFs in general are always trying to peg like a market on close. So most products, whether that be us or others, are trading right towards the end of the day and getting filled, as opposed to something in the middle of the day, just because that also throws off a lot of market makers. If you've completely changed your risk and exposure in the middle of the day, the market maker was expecting something from the night before, they're going to be completely miss off on their hedge, their spreads will be off and not close to NAV. So generally most ETF issuers trade close to the end of the day, but yeah, we will institutionally manage the execution of the fills with our brokers, wherever we're working on executions.
Okay. All right. Well, that wraps up most of my technical questions that I've had. Does anybody else have any other technical questions? If not, I'd like to move into kind of like your background and how you got into all this. And because with any kind of actively managed fund, it's more about, who's running it and how they're managing it and their experience and background than just how something's coded up.
Yep.
I think we might have one more question. He's typing it out right now. Well, while he gets to that, so when did you first get into trading and stock market stuff?
I was in high school, starting to manage my just own portfolio in trading. When I went to college, went to the Roger Williams University. It's up in Rhode Island. But the reason I went there was it was the Gabelli School of Business. Mario Gabelli is a very well-known value investor, equity value investor, billionaire himself, runs Gabelli funds. And he is the backer to the business school there. And ultimately, they built out a program that was called the Center for Advanced Financial Education, and that allowed students at the university that got approved to run a real dollar portfolio. So you'd be taught portfolio theory, analytical, fundamental, technical, behavioral analysis, and then you run a portfolio for an entire semester and compare yourself to the benchmarks. That's where I really got into it, and that's the reason I stayed at that university and didn't transfer off to somewhere else, was because of what the program offered from an experience. And then I rolled into working in 2008 when I graduated. In June of 2008, it was a great time to be getting into the brokerage business, but also just financial services. I joined an institutional trading firm that was in Connecticut, cut my teeth, got all my licenses, and then I spent a lot of time covering the largest hedge funds in the US and some around the world, on their trading execution, from cash equities to building option strategies and talking to them about options, and ultimately worked with that firm to build out a whole options desk that they offered out to all the hedge funds and mutual fund companies and pensions that they covered, and focused most of my attention on covering hedge funds that, hey, how do you do a single stock option replacement? How do you have a better overall lower vol and a higher Sharpe ratio using options in your strategies? And so I did that for a while, and then moved into starting our first asset manager that was ultimately acquired by Ray, which ultimately then acquired Global X. So I worked, basically building our first ETFs, which was QILD and such, until we've, gotten to basically here at Neo. So definitely been a long time, and also focused on really doing the same thing. I did bounce around from, private equity to equity investing to anything else. Been the same throughout my career path.
Did you first get into options in high school and in college? Is that when you jumped into options? And what made you gravitate towards options versus any other form of investing?
Yeah, so I got into options in college. I just thought they were interested in finding ways to mitigate risks and take a small amount of capital and be able to take a more of a directional bet on what I wanted to post as margin and collateral against it. But really, it was starting to talk to the hedge funds in my first job about, what does this look like for a portfolio, and how can you use options as ways to, enhance either returns or mitigate vol and risk. And then I started to think then in my first firm, the Recon Capital one, we managed money for ultra high net worth in a couple of family offices. And so we were creating strategies on how to generate tax efficient income. And we said, wow, we can't get these products out in a public wrapper or any type of fund structure. let's start to issue our own ETFs using option strategies to generate, kind of current income and those things. So that's how it really kind of matured from that standpoint, is the fact that we just couldn't find product out in the marketplace that fit with what, our clients and investors needed at that point in time. And so we started to create them.
Okay. I got another question back to the technical stuff. I assume from option limit orders, you must be using some type of execution algo. What criteria, if any, do you use to move your option limit prices as the market moves? I'm sorry if this was asked somehow implied earlier, besides holding underlying assets. Do you hedge your delta exposure in some other way? If so, how?
Yeah, so the latter first, we don't have to hedge our delta exposure because our everything we're doing is in a spread format in a package. So we're taking whatever our exposures that we want in that initial trade. So we're not taking any risk or principal capital like a market maker would or our executing partner, where they want to hedge out their risk and their delta, basically on the other side. We're adding small amount of deltas, we're subtracting small amount of deltas depending on the product. And as for the execution side, what we're looking to do is basically, assess where the market's headed over a very short period of time, right? A 30-minute window, an hour-long window, closer to the end of the day, to get filled on what our execution is. So if we're not going to get filled at a limit, then we might go out there and start to, look to find liquidity that's, interspread between the bid and the offer to get our overall fills, and execution done. But if we can, we'll generally try to sit at our limit and let somebody take, our offer if we're selling something, or, have somebody come and, hit our bid, if we're buying something. So we'll try to stick within a limit and a specific range. And if we can't get that, depending on the timing, what we need to do, we usually tend to go out and for SPX index options, I mean, we're talking the pretty tight market from a bid offer spread, given the liquidity of the underlying and it being the largest option traded market in the world. But if we need to, there's plenty of places and anyone will kind of fill our orders within, that bid offer spread.
Okay. And he says, thank you. So you said you have 12 guys on your team that handle all of the analysis and entries and stuff. How exactly do you go about bringing people onto your team? Is it through just people through your network, or do you bring from the college, or how do you put together this team?
Yeah, so most of the team are people we've known in the business. We've worked together in the past at any of our firms. We've gotten to know each other. So the people that come and join us tend to have a relationship with us already. The 12 is more from a firm-wide standpoint in total. There's really 3 or 4 of us that are working on the investment strategy, the analytical work, and then obviously trading and portfolio management. There's 3 of us listed in the funds as portfolio managers. So when we're thinking of recruiting, it's open. We basically put out job recs out there. We interview people. We send the job recs around to people we know in the industry, ask for any referrals. And those people have to, obviously just fit in like anyone else with equal opportunity employer. Doesn't matter who it is. We just want to obviously get the best person for that role and what they're doing specifically.
Okay. Well, if anybody's listening that would like to apply, that's your cue, I guess. Okay. I can't think of any other questions. Is anybody else got anything? It sounds like a very, I've already talked a bit with you about this stuff and the interesting product, but it definitely, I've got some ideas on strategy design, especially for very high account values using this. Or we haven't done any yearly strategy design, but that would be very interesting to do. With you said 60% of the income is taxed as capital gains, correct?
Yeah, so from the option side, 100% is taxed as capital gains. It's just, it gets broken out. The IRS, because this group is technical, it's called a 1256 contract. You can just Google that, IRS 1256 contract. It gives you the same treatment that a futures contract would. So because they're cash settled, that means any profits and loss from, it's 1256, 1256. So 1256. That just means any gains from the options that you make are capital gains, but 60% are taxed at long term, and 40% are taxed at short term. Right, short term is ordinary income, but the 60% at long term gets your long term tax, capital gains rate.
Okay, Jim, I've never done a wash sale, but I know you did one this year. How would you see wash sales in this handling?
I I'm not one to give tax advice, but I do think it depends on the underlying, and I think you'd
So I
have to go
can-
to tax advisor, and I'm sure that Garrett has more close view of that.
Yeah, we don't have wash sales because every option contract is always considered a new security. So we're not going to trade in and out of the same option contract. So even on a weekly rebalance, we're going out 2 weeks in our fixed income products, and we roll every week. So every time we're entering into technically a new option, a new strike, which is categorized as a new position, right? Like as opposed to an equity where you're in and out of Apple multiple times, every option is basically a new security for the for regulatory and tax purposes.
And I thought I heard you say you're cash settling the options, and you're not actually letting the equities and the underlying being called away, right? So you're not selling the equities, so you don't have that problem either from a wash standpoint.
Yep, exactly. So all the index options, you'll see that in the 1256 contract, they're all cash settled. They're called European options. And because of that, essentially all we would have to do is it's up to us to come up with covering the liability. So we will sell a portion of the underlying equities. But what we do is when we sell a portion of the underlying equities in these covered calls, you have a loss on the options that's basically almost identical. I can't say perfectly, but identical to what the gain of the equities are. So your losses and your gains offset one another. And so that's how you don't have a taxable implication. But instead of having it as an equity being pulled away, you're doing it from a cash settlement standpoint.
Just curious, as Garrett has already alluded to, the crowd we have here has done a lot of work on modeling different switches and trying to understand how to play different ETFs and their behaviors against each other. I find it very interesting what you're doing with the BND on the fixed income side. Do you have any other categories, like for example, commodities? Would you take something like a DBC and then look at a covered option against that, or other parts of the market you're looking for new products?
We haven't done anything in commodities yet, but yes, all of those are open. So kind of anything that would be a core building block in somebody's portfolio is something we would consider, whether that's other equity indexes, US, global, emerging frontier, or if you think about the fixed income curve, are you in, short duration? Are you in medium, intermediate term? Are you in junk? Are you in high yield? Or alternatives, right? We look at MLPs and REITs and commodities and different types of yielding assets. And that's where the digital asset also comes into play as kind of more emerging asset classes. We don't have anything in the moment that's slotted or planned, but, we would definitely continue to look to be kind of what we feel as a solutions provider and just being agnostic to that, creating product that people could pick where it fits in their portfolio, and each portfolio is different. So we want to give them the flexibility.
Yeah, but is it fair to say the model you're using to analyze, to use your terms, all the Greeks involved with the options around the underlying, you could lift a land on any underlying basically. So you could take a look at that and what's doing any very liquid, large ETF fund or mutual fund, you could probably lay that against.
Correct. Yep, correct. Yeah, as long as there's good option liquidity, and we feel it's also coming from a good tax efficiency standpoint for those options, then we could look at any underlying asset class and pair an option strategy or overlay the model to it. Usually based on the asset class and what we're trying to achieve, the model will, change, right? It'll focus a little bit on either lower risk or certain items, or right, if we went and did a NASDAQ based cover call, right, we'd be long the NASDAQ 100 and sell NASDAQ 100 index options. So we'd use the NASDAQ volatility index, which is VXN, as opposed to VIX on the S&P. So different asset classes and different underlyings might get, a change to the model based on, what it's trying to achieve. But you're correct. We'd overlay a quantitative approach to anything that's got a decent liquidity and options market to it.
Hassan's got a question, but actually, let's go with Hassan's question, but I got a question on volatility in the future. Hassan, question, have you considered capturing the delta between ES and SPX on a quarterly scale? And for reference, anybody that doesn't know, ES is futures, correct? If I'm right, is ES futures?
Yes.
So short answer is no, we haven't. When we try to create these products, we try to keep them also simplistic for the general investor. And so we have not looked at kind of arbitraging anything between like a futures and an SPX on a quarterly basis or anything else.
Okay. Back to volatility, as far as future roadmap or products that you might be, have you ever experimented, maybe not with NEOS, but just in the past, have you ever tried to experiment with some kind of volatility VIX ETF that has this kind of strategy to offset the natural decay of something like VIXY or EVXY?
Short answer is no, not for a product like this in an ETF. It gets to be too complex, and volatility and the risk we feel from an underlying standpoint to end investors, we've really focused more on kind of core building blocks as opposed to, you know, trading type vehicles. But you certainly could. There are other people out there trying to do that, or they'll use VIX options and futures to hedge. It's a little bit bigger of a market in the mutual fund space that I've seen than kind of in the ETF space, but nothing from us particularly.
Do you know of any tickers specifically that do that?
Not that haven't had issues or blown up. So I don't. I'd have to think about it. I do know a couple of mutual funds that used to try to trade a lot of that stuff, and right, they're kind of selling put spreads on, you know, a VIX or IVX or all those things, and that all ended somewhat poorly or horribly.
Yeah, we've been experimenting with designing strategies around volatility using multiple switches to make sure that everything's confirmed before we go into a position. But yeah, it's a interesting strategy. Okay, so Dom says, tax efficient income, how strongly does this impact strategy development? At times, I'd imagine it feels like fuel economy mode on a Porsche.
Yeah, so the tax efficiency doesn't really come into play in what we're predicting on a total return for these products per se. We use S&P index options for the tax efficiency. That's the main characteristic for us in these product sets. If you were to trade like SPYI ETF options, right, all of the income from that is generated as short term. It's 100% short term. So why would we trade an ETF option when we could trade the index option? I get Dominic's question. I think when it starts to hinder performance, no, right? We look at performance versus tax efficient income. And if the product is going to just have a lot more alpha to just generate off of using something that's less tax efficient, we would assess that and say, okay, great, can we net 15%, you know, after tax from a not tax efficient product, or do we end up with a 10%, you know, net after tax trying to be tax efficient? So at the end of the day, we still want to have, you know, what we're saying is the most tax efficient return, whether that be total return or the income. But right now in all these products, the tax efficiency really refers to the categorization of the distribution and the fact that we utilize index options. And mainly it's the index options.
Okay. Hassan says he still remembers the XIV implosion. Was XIV an ETF or an ETN?
It was an ETN, but there was a bunch of them. They've already tried to, another firm relaunched some of those products about a year ago to try to come back, but I know they threatened a big lawsuit with the SEC to get it approved, and eventually I think they won that and they launched these products. But yeah, crazy. I mean, that was a tough time for a lot of shops, including option-based firms that were, you know, leveraging put spreads and all sorts of other things, and ultimately like LJM down, you know, 85% in like 2 days.
Yeah, I've studied ETNs a little bit, and I know they're much more dangerous than ETFs as far as implosion and stuff. What exactly is the difference on a technical level, the structures of like an ETF versus an ETN?
Yeah, so an ETN, an exchange traded note, is a fixed income note that is issued by a bank, right, or an institution. So Credit Suisse or JP Morgan. And basically you're going to get exposure to an underlying portfolio similar to what you would get in an ETF, but it's done in a note format. So it's really a fixed income instrument that's fully collateralized by the issuing bank. So let's just call it Credit Suisse goes under and has, you know, billions of dollars worth of assets sitting in ETNs. You instantly become just a creditor of the bank, right? It's not an independently operated ETF. An exchange traded fund is listed with an independent board of trustees on a Delaware trust. So there is no entity in theory that actually owns the assets in the underlying. Those assets being owned in the product or those of all the investors that are in it. So there's no way to have the credit risk of, let's say, the issuer. Let's just say Neos or any firm closed down that's running an ETF, right? The assets in the fund will still continue to operate because it's all of your individual investments. An ETN is being collateralized as a note being issued by a bank, and you have the full faith and credit of that issuing bank, and that's it.
Yeah. Okay. So the risk is much more distributed rather than like a single point of failure.
Yeah, exactly. ETFs are just aggregated pooled vehicles managed on an independent trust. And the ETNs are issued by a bank as a note, right, as a creditor to the bank.
Okay. All right. I think I'm out of questions. Anybody else got anything? We're about to hour and 10 minutes in. Okay. Well, if nobody else has got any questions, I guess this would be a meeting adjourned. So where can we find more information on your stuff? What's your website? Could you share it in the chat?
Yeah, I can do that. It's neosfunds.com.
For a roadmap in the future, what do you think the next products you guys are going to launch? Maybe sector ETFs?
We've looked at sectors. That's definitely on the potential docket, certainly more within what we're doing. So taken from an S&P to a NASDAQ to a Russell 2000 on the equity side, global looking like an MSCI ACWI with an overlay to that on the equity front. And then on fixed income, going out more probably longer duration and less creditworthy. So looking at like kind of junk, high yield, preferreds, those types of things that people could choose kind of their risk exposures. So those are the short answers, and maybe something in the alts category, like, you know, REITs and MLPs. You know, how do we offer, you know, different differentiated products with those?
Yeah, I think an emerging markets would be a nice one because there's a lot of volatility there to mitigate.
Yes, yeah, for sure. Plus, you get a higher dividend yield. So as a yield investor, right, you go international. You know, historically, you know, EM and developed international pay higher dividends than the US does.
What is I haven't looked at that specifically. What is the increase versus US?
Good question. Let me just look up ACWI right now. So the iShares ACWI ETF, ACWI has a horrible yield. Actually, it has 74 basis points of a yield right now, which is surprising. Usually it's higher. And I'm not exactly sure why.
Is that a currency hedged fund, or are you exposed to the FX as well?
That one is probably exposed. This is like the broad, like $20 billion ETF. But usually it's usually an uptick. Like, I shouldn't say this. This is years and years ago, we used to have like a DAX Germany product and a FTSE 100 product at a previous firm, right? And those were yielding like 2.5 to like 3.5% from a dividend, and the S&P was like 1.5. Right, so you had a decent amount that's developed. Obviously, getting into EM, and it depends what EM, right, or frontier you're looking at. Some obviously have no dividend yields because they're very much emerging countries and equities and companies, but you tend to usually get a little bit more of a pickup of a yield by being in more, you know, global.
Do you know of any gold ETFs that use this strategy?
There's a gold cover call, GLDI maybe. It's noted it's an ETN, but GLDI is a gold covered call ETN that Credit Suisse has, and it's got about 100 million in it. 65 basis point expenses, but it's been around, I think, for a decent amount of time.
Yeah, I've used GL or GLDI. I. Is there a silver one? SLVI? I think there's an SLVI. I'm assuming it's the same.
I don't see it, but that doesn't mean it doesn't exist. I think you're right. Somebody's got it, but that's not the ticker.
SLVO.
Yep, that's a SLVO.
We got another question. What's your commissions on option sales? And I'd imagine there'd be a drag on returns. And on that, also, what's your expense ratio?
Yeah, expense ratios on the funds. SPYI is 68 basis points. BNDI is 58 basis points, and CSHI is 38 basis points. Our commissions, that's a good question. I think are 50 mils on equity, so half of 1 penny. And then I think we are roughly $1 a contract on the options, but because they're index options, you got to remember that they're worth over, let's see where the S&P just closed, 4,070. So one option contract is worth $470,000. So if we trade one option contract and pay $1 on a $470,000 trade. It's 0.02 of a basis point. So it's very minimal. And that's why we also use the index options as opposed to an ETF option, which would be significantly north of that, because you're divisible by basically, let's call it SPYI is probably 400, 405. So we're basically getting 10x the exposure per contract.
Okay. All right. Well, with that said, I want to thank everybody that's jumped on the call here, especially those guys in the voice channel and anybody that's been asking questions. Thanks, Garrett, for your time and running us through this and explaining more about it. I definitely got some ideas on how to use this for specific strategies, especially like a larger cap account. Yeah.
Great. Well, thanks for having me. It's great to meet you guys. Really appreciate it. And always around to chat about investing. So definitely keep me included on all your future stuff.
What are you most interested in as far as like further conversations? What do you study a lot when it comes to the market?
I'll put my personal hat on that. I think personally, growth and income are still obviously like core, to me. So thinking about what products get a good solid risk-adjusted return from an upside perspective. And then also other ways of just, how do you generate, kind of income off of your portfolio? So, I mean, kind of the same thing, but yeah, I'd be interested to catch up with you guys more on the stuff that you're talking about from an investing standpoint. Just personally to be on the list.
What another question, book recommendations, and I got another personal question. What sectors do you feel are going to be pretty bullish over the next few years? We've been looking at industrials, energy, AI, obviously, and maybe materials.
That's a hard one. I really don't try to take the bets on sectors, but I tend to agree with you. I've had a number of people speak on some recent webinars from a macro standpoint. They've been suggesting taking some of the profits off of energy, that they've seen. They think consumer, some of the tech can bounce. It already has this year. So I don't know what's left of that, but everybody in the last couple of weeks have been, talking about just at least, bigger tech taking a bounce. Like you're more insulated ones, right? Apple, Microsoft, ones that have real robust businesses and cash flows and cash on their balance sheets. So kind of tech and those they've been suggesting. I would say books overall, option volatility and pricing. It depends what you're trying to do, right? If it's more trading related and algorithmic stuff, right? Option volatility and pricing is a good one that I've read. But if you're thinking about just general books, I mean, I've read more of like entrepreneurial books, right? Like Peter Thiel's book, Michael Jordan, like those types of things, just from a more business and entrepreneurial standpoint.
You said Peter Thiel? How do you spell that last name?
Peter Thiel, Founders Funds. He's the co-founder of PayPal. Let me see which exactly was the last one I just read with him.
Oh, here's a good one. So we have a unique background in our Discord, but we have a lot of people that are very good at math and science and data analysis, statistical analysis, or coding. Proteus asks, what should an unsophisticated investor with a sophisticated math and comp background be reading?
I don't know the answer to that one. It depends what interests them. I don't really know the answer. I mean, I think from an option standpoint, the one I mentioned before, I think, any of the real statistical, any of the more math focused options books, which is really getting into like volatility and pricing. There's one that I've read that's really good. And I'm forgetting the name about it. I might have to follow back up. Used to tell our interns always to read it, and I'm blanking on what it is. But I would say anything obviously deeply analytical and options and pricing and volatility surface, I'd make a suggestion on. And then the Peter Thiel one that I read was 0 to 1. So that's kind of his kind of core book that was out there, 0 to 1.
Okay. Yeah, I dabbled in options for a little bit, but I learned very quickly that I'm not organized enough to do options. There's a lot of data and spreadsheets to do it correctly.
It is. I'll be honest with you, when I read options books, they tend to put me to sleep, even though I love them and I think about them. It still can be pretty monotonous just reading about it. So,
yeah. All right, guys. Well, guess that's meeting adjourned. Again, thanks everybody for hopping on. Thanks again, Garrett.
Cool. Thank you guys. Really appreciate it. Have a great weekend, everybody.
You too.